So from someone who's been doing this for a very long time, and I love earnings season because I just, you could tell when we cover it, and I love listening to conference calls, which, I read the transcripts, which is quicker, and it gives you a good indication on geography, what areas are strong, what different industries they cover. A lot of these companies are in, 10, 15 different industries. It helps me find ideas for smaller names. It just filters down. I love it. I love to hear what they're saying. And usually when a major company, industry leaders are coming into the quarter and they're going to miss by a mile, they warn. They tell everyone a couple weeks before and say, here's our guidance. It's going to be freaking terrible. And then when they report, they usually beat that weak guidance, right? It's like a kitchen sink type thing, usually. Walmart and Target didn't get the chance to even do that. And you want proof that they do that? What happened after Target warned and Walmart warned and those stocks got crushed? Target, 2-3 weeks later, warned that next quarter their margins are going to be a lot lower. Right? So they didn't even get the chance. That's how quick this can happen. But reporting their terrible quarters 2 months ago, they cited inventory concerns as demand suddenly fell off a cliff and surprised them. So they're sitting on massive amount of inventory. I think it's 35% on average across the board. 35% inventory? What are you going to do with inventory if nobody wants it? You got to sell it at a cheaper price to get rid of it, to dump it. You have to. You're going to give it away to TJ Maxx's and stuff and those companies. But you got to dump it. But both companies didn't have a chance to warn investors. And what happened? Walmart and Target, their stocks absolutely crashed when they reported earnings. They had the largest, both of them, the largest one-day drop in their stocks since 1987. That's how quick this changes. I know people are late on inflation and say it's going to go up, it's going to go up, it's going to go up. Something we've been saying for a very, very long time that it's going to surge. Absolutely surge. And I didn't even think it'd be at these levels. That's why we still have a lot of stocks in our portfolios. We're doing good in our portfolios, but we could have reduced the damage if I really thought it was going to go that high. And it's still not being controlled. It's still going higher. It hasn't just, stopped or topped out yet. But getting back to deflationary trends, global growth is slowing. Commodity prices, like I just said, are falling. Home prices, sales are slowing, obviously, right? There's less people that could take out a loan at these rates. And prices started to come back where sellers are lowering their offer prices, which data confirm that. Again, all this data in like the past 10 days. Started with Walmart and Target, which was about, 6 weeks, 2 months ago. But we're seeing a plunge in money growth. Consumer sentiment is at a record low. Record low. Say that, a record low in this market. Consumer sentiment is worse now than it was in 87, than during the tech bubble. During the credit crisis, during COVID, sentiment is worse now. Why? Because we can all identify with inflation and we all see prices going up, and that's all everyone wants to talk about. But we're definitely seeing signs of deflation, and I don't know why it's not being mentioned. So if that's the case, that means inflation is starting to come down. We'll see food and energy likely take longer. I covered those sectors. It's going to take longer to come down, especially food. But this is great news if you're looking to purchase equities. And why? Because the one problem, there's one problem. That's it. There's one problem. It's not the war. It's not another strand of COVID coming. Okay, these are temporary events. The war with Russia, I know Ukraine's been going on a lot longer than expected. It's not going to go on forever. Russia can't afford. Russia's in the driver's seat right now where they could get anything they want from Europe and the U.S. just to stop the war because it's going to help our economies tremendously and curb inflation even more. And everybody wins. I mean, no one's going to say Russia won, but they can do whatever they want under the table in terms of politics, and it's going to be great for everyone and great for the world if they end that war, especially on the food front, on the energy front, on everything. But the one problem we have is inflation. It's the one thing the Fed cannot help you. They have to do the opposite. They have to force a recession, something we've been saying for a long time, force a recession. And I think it's funny when people say, oh, we're probably going to avoid a recession. Or it doesn't, we feel like we're in a recession. I mean, stocks are down. You're going to see home prices probably come down a little bit. A lot of asset prices are coming down. A lot of leverage coming out of the market. It feels like it. You see prices through the roof. Everyone's seeing it. Restaurants, everywhere you go. We're seeing it, right? But inflation is starting to come down. And this is good news. We need to see this. Because when it starts coming down, what's going to happen? The Fed's going to be able to say, communicate. This is important for you to understand. We know inflation, paying $5 for, well, it's probably a little bit less than that. Oil prices have come down. But if you're paying $5 at the pump on average and it goes to $4.50, look, it was $3 a year ago. So you say, Frank, we're still paying these higher prices. That's not the point. That's not what's going to drive equities higher. What's going to drive equities higher is the communication from the Fed. Because right now, the communication out of the Fed is what? We're doing whatever it takes. We're raising rates aggressively, shrinking our balance sheet, because we need to control inflation right now, which is out of control. That's the message, finally, which should have been the message 9 months ago. I don't want to look backwards, because everybody can play Monday morning quarterback. I want to look forward. And the Fed's doing its job now. That's the message now. But if that message changes to, okay, we're going to slow the pace of rate hikes, and that could happen based on everything that I just told you. That's a lot of factors that you have not seen on financial news like China, and you haven't really been reading about it too much. Wall Street Journal covered a little bit here and there. Again, we read all this stuff. I read all this stuff. Daniel reads all this stuff, and we're watching the gauge sentiment on CNBC all the time. That's my job. To help you guys out. To listen to all this and tell you what's bullshit and what's not, right? That's why you listen to this podcast. But when you look at inflation, if the Fed comes out and says, hey, you know what? We're going to slow the pace of rate hikes. And that could happen September, October. Because we're going to be at what? 2.5, 2.75, close to 3% then? But based on the data that I'm seeing, that could happen. If that does, that's going to send equities screaming higher. Because most equities are down 25% plus. I'd say most of them are down 35% plus. Some large caps have held up a little bit better, down 20, 25%. So now what? Now we're heading into earnings season pretty soon. And I think we're going to see lots of companies warn where profit margins are going to decline. You're going to see that. And you have to realize from a company standpoint, the worst environment is COVID or the credit crisis because you can't see what's coming. You can't see what's coming. Every single company knows the inflationary environment. They know their supply chain sucks and they have trouble getting shit to their stores to sell. They increase, they find any way they can to get more and more supply. Now demand's falling off. But these companies see the problems. They understand inflation. They understand inventory concerns, which makes it easy for them to adjust. That's why you're seeing companies lay off employees. The easiest way to save money, unfortunately, not for the employees. It's unfortunate for the employees, but for companies, that's the largest expense. So you're seeing, companies here, companies there. 10% layoff, 20% layoff. Netflix, the crypto companies, Robinhood and Coinbase and things like that. But they could see, they understand the environment. So they're going to be cautious and they're going to warn and say, listen, okay, we want to be cautious. And now's the time to be cautious because we just saw that in Nike. Nike's results weren't that good. China is a huge uncertainty and they just reported the stock was down like 3%. Then it was up a little bit. I think it's down like 2-3%, but people are a little worried. But under normal market conditions where the market didn't crash, Nike would be down 15-20% today on this because they reported good earnings, but they warned and they said, we don't really know what's going on with China. There's too much uncertainty, and people hate uncertainty, but they said uncertainty around further COVID disruptions because Nike is a China story. That's where their growth comes from. They have a little bit of inventory concerns, and they lowered their margin guidance, but the stock is holding up pretty well. That's not too bad. So, you say, well, how come it's not down more? Because it's already down 40% from its highs, which was just 6 months ago. It's trading at 179. It's trading at like 108 today. But we're seeing a lot of potential earning warnings. That's what I'm seeing in a few. We're going to see potential earning warnings, weaker guidance, but it's going to be factored into stocks. That even happened with Target when it reported. The second time, the stock crashed 35-40%, and then I think it was a week later, 2 weeks later, said, all right, our margin guidance and lower than margin guidance is going to be terrible, and the stock took a little bit of a hit. It was down like 8%, then finished down 2-3%. But that's what you're seeing. And Target may be down from those levels because the whole market sold off over the past 5-6 weeks. It's really been 12 weeks before last week. 11 out of 12, I think it's come down. But you're getting my point. These stocks are already factored in. It's being factored in. They're going to lower their guidance. And now's the time to do it because you can get away with it. I mean, you got to put all those strings, and Nike's the best when it comes to earnings manipulation. I'm not talking about doing anything illegal, but it's very easy to manipulate your earnings. Talk about currency, X this and that, and all this bullshit. Believe me, I followed Nike for a long time. They're the best at doing it. The best at doing it. Buybacks, massive buybacks. I mean, there was a time where they would have missed 3 quarters in a row, but they beat the quarterly estimate. Stock went up only because they bought back the stock, which they're great at doing. But now's the time. If you're going to warn, it's expected your stock is down. And that tells me why. It tells me we're close to a bottom in equities. We're close. I know it sounds crazy because you watch TV. I mean, so you're seeing consumer sentiment. I just said at record lows. But when I see 99% of the so-called gurus on CNBC, and these guys are bullish all the time. They are bullish all the time. Bullish, all the time. When I see 99% of them, I mean, I can't even name someone that's been incredibly bullish here telling you to buy. Or just buy a little bit. Not even incredibly bullish, but saying, hey, we're close. Nobody. But when I see that, and all these guys are saying it's going to get a lot worse, the more bearish than ever, that's what you need to see to form a bottom. Zero optimism, no hope, everyone throwing in the towel. We're pretty close to being there right now. But consumer sentiment at all times, record low.